Live from Tokyo, this is Insight with me, Sherry-Ann, where we dive deeper into the stories that matter with crucial context and analysis. Nasdaq futures slump while Asian shares see optimism around China's AI progress, shrugging off Donald Trump's imposition of tariffs on Colombia that cut risk appetite elsewhere. Trump rattling global markets by announcing a 25% tariff on all Colombian goods after the country's president refused to allow planes carrying deported migrants to the land. Also ahead, Bloomberg Intelligence sees China becoming the primary contender to U.S. dominance in AI, as models from DeepSeek show how more can be achieved with less. And Indian stocks are no longer the favorite among global money managers, with foreign funds selling shares worth $19 billion in January. The Nifty set for its worst monthly losing run since 2001. Take a look at how broader markets are trading at the moment. We do have thinner liquidity today, given that we have several markets closed, including Australia and South Korea, Taiwan, Vietnam, and Indonesia as well. But we have seen that optimism around AI in China with DeepSeek. But we'll see how long that optimism lasts and the gains in the Chinese stock markets, given that we also got data with China industrial profits dropping for a third year, manufacturing PMI falling into contraction territory. The Nikkei as well has actually turned negative from positive earlier today. Investors selling big Japanese tech stocks. Of course, there are big questions about what happens to the dominance of some of those U.S. tech firms, including NVIDIA, if we do get more progress in Chinese artificial intelligence. And of course, there's also the risk of surrounding tariff threats and actual tariffs and sanctions being announced. President Trump saying that he's implementing tariffs and sanctions on Colombia for refusing to take back deported immigrants. The move is the clearest signal yet of how Trump sees tariffs as an economic weapon to be used against governments who oppose his goals, whether allies or enemies. For more, let's bring in Bloomberg reporter Andrea Jaramillo in Bogota. Andrea, given that President Gustavo Petro has already announced over X that he is going to be deploying his own personal presidential plane in order to get these migrants back, are we seeing a little bit of easing in tensions and the escalation that we could have potentially seen the rest of the week?
Well, we're going to see. I mean, the Colombian government actually a few hours ago said it would speak, and we're still waiting to see if that will happen. Of course, it's already evening in Colombia, and we'll see if we'll hear something from the president today or wait until tomorrow. For now, it has been through social media posts, through X, where he has said has picked this fight with President Trump.
That's the interesting part about this, right? Because we weren't expecting anything against Colombia, especially given that it has had very warm relations with the United States. What's going on around this?
Right, we weren't expecting this. I mean, we were seeing Mexico, Canada, and of course, we knew that relations between President Trump and Colombian President Gustavo Petro weren't going to be as warm given the different stances they have. Petro is Colombia's first leftist leader, and so we weren't expecting relations to be warm. And as you said, Colombia historically has been a strong ally of the U.S. And so right now we're really in a position where we haven't seen Colombia versus the U.S. in this position. And we're really trying to watch and see what will come of this, if really this fight, social media, fight on social media will escalate.
Yeah, especially on how some of those concrete measures are taken, right? Andrea Jaramillo, Bloomberg reporter there, joining us from Bogota late in her evening. And we also want to bring in Claire Reade, senior counsel at Arnold and Porter and former assistant U.S. trade representative, joining us from Washington, D.C. Thank you so much for staying late for us. But continuing that conversation with Andrea, what's the feasibility of these trade actions, tariffs and sanctions being imposed this swiftly this week?
Well, the president the United States has quite a number of tools at his disposal. The State Department has already announced visa restrictions on what they call the Colombian government officials who are, quote, responsible for this action. We have not seen any formal White House announcements about tariffs, even though we have seen the social media back and forth. I think the problem here for Trump is that he wants to project great strength with regard to his immigration actions, given that they played such a major role in his campaign, both in terms of what he promised and the emotional appeal of these statements about ridding the United States of illegal immigrants who are especially criminals.
Not to mention, of course, his fight against drugs and the flow of fentanyl as well, which has also been targeted against China, right? When it comes to actually applying these tariffs, you talked about the president having really broad powers, but how fast could it be implemented, especially on some of those security concerns that he needs to use and without the public approval period?
Well, the structure of the laws in the United States are such that Congress has passed laws that put tools into the president's hands and allow the president to exercise discretion with regard to how to take these actions. So there are, with regard to tariffs, some practical steps that have to be taken in order for Customs and Border Protection to know which tariffs are being applied to whom, but it will not require a period of public comment or any of those kinds of delays. It can be implemented very quickly.
When it comes to China, have we seen already actions that could eventually lead to that, especially a repeat of what we saw back in 2018 when he implemented tariffs of about $380 billion? Are we setting the process up for that to come as quickly against Beijing?
Well, it's interesting because this past week when President Trump was inaugurated, he issued a number of executive orders, including one on trade. And the one on trade directed a number of government departments to study the ways to impose tariffs and to study the legal mechanisms for imposing them and to make recommendations by April of this year in terms of what he could do, under what laws, and which products should be targeted. So at the moment, that broad-scale effort is underway among the U.S. Department's executive branch. In addition, of course, he could do what he did today with Colombia and make an announcement as an emergency for national security grounds or other national emergency grounds, and not wait to use the other laws, including the law that he used with China in 2018. That law was called Section 301, and that law did require the government to take a number of steps before the tariffs could be imposed.
Yeah, there have been comments that use of existing 301 investigations could actually form perhaps a foundations of just increasing the tariffs on Beijing. But of course, we do also have sort of parallel actions when it comes to tech export controls and trying to rein in Beijing's ambitions on advanced tech. Claire, today we have a rally and optimism around artificial intelligence developed by a Chinese startup. How much has Beijing been reined in when it comes to U.S. actions in order to stop the flow of advanced tech and advanced tech-making capabilities to Beijing?
Well, I am not an AI chip expert, but my understanding is that the last Biden administration export control announcements were quite comprehensive with regard to AI chips and related products. And therefore, my sense is that with regard to the sort of traditional large computing models for creating AI, that there really has been a barrier erected for China to be able to do what the big players are doing in AI. That said, there are alternative Chinese efforts that are underway, which are making some headway.
Which is why we're seeing, even here in the Japanese markets, investors selling big tech names like Tokyo Electron, Disco as well. When it comes to these third countries, it's interesting here in Japan as well. Because of a weaker yen, this graphics right now for our viewers showing this huge trade surplus that Japan has against the United States, the fifth highest on record at the moment. How is this likely to trigger President Trump, especially when it comes to future actions that could take place against third countries that are sitting on the sidelines, and the fact that Colombia is an ally and a friend, and Trump is willing to impose these tariffs? How does this preview some of his potential future actions against friends?
I think the reputation that Trump has of being quite, how do I put this, of acting very swiftly and on the basis of an impression that he has at the moment creates a lot of unpredictability. And I think that everyone is going to have to be prepared for that fact about him. It's also clear that he likes to try to create leverage where he can then drive a hard bargain that he believes will allow him to come out the winner. The question is always whether there is an appropriate assessment of the costs and benefits of taking a spontaneous or somewhat impulsive action relative to a slower and potentially less dramatic action. Sometimes it makes sense to wait and think a bit more, but I think President Trump has a lot of confidence in himself, and so I don't think he's going to take the slow route.
And it seems that the White House has achieved, at least for now, its intended action. The White House has just released a statement saying that Colombia has agreed to President Trump's terms. They're saying that the government of Colombia has agreed to all of President Trump's terms, including the unrestricted acceptance of all illegal aliens from Colombia returned from the United States, including on U.S. military aircraft, which was one of the contentions that President Gustavo Petro put forward, without limitation or delay. So some of that flexing when it comes to tariffs, 25% on Colombia, seems to have worked right now. The White House, at least from their side, saying that Colombia has agreed to all of Trump's terms and that visa sanctions for Colombia will remain in effect, though. Claire, when it comes to the sequence of actions coming from the Trump administration, we have seen him talk more about Mexico, more about Canada. Nothing specific about China other than just a broad level of tariffs that could potentially come. Do you get a sense of what the priorities will be for this administration on which countries he targets first?
That's a very good question. I think we have to look at Trump's political agenda and what he promised during the campaign in order to see what his priorities were going to be. So the fentanyl issue is very high on his list, and that implicates China, but it also implicates Mexico. I'm not quite certain how it implicates Canada, but in any event, that is clearly going to be a very high priority for him. In terms of China, though, China is a longer-term challenge, and I think President Trump, while he has expressed great respect for President Xi, also has a strong competitive spirit and is going to want to come out on top in any competition. So I think you will see concerted and potentially long-term and widespread actions against China over the course of this term by President Trump.
Claire Reade, it was really good to have you with us. Thank you so much for your time late in your evening. Arnold and Porter at Senior Counsel and former Assistant USTR for China Affairs. As we get the latest from the White House right now, that Colombia has agreed to President Trump's terms and saying that based on this agreement, the fully drafted tariffs and sanctions against Colombia will be held in reserve and not signed unless Colombia fails to honor this agreement. Still ahead on Insight, Asian economies were spared from tariffs in President Trump's first week in office, but UBS Wealth Management warns of a bumpy road ahead. More on their market strategies coming up. This is Bloomberg. But we're seeing the dollar trimming some of those earlier gains as we saw the White House now saying that Colombia has agreed to President Trump's terms when it comes to deportation of migrants. On the other side of the trade, we're also seeing the Japanese yen strengthen. We had some safe haven flows already throughout the session on those tariff news. And of course, we're also coming off the back of that BOJ rate hike to the highest level since the 2008 global financial crisis. Joining us now is Kei Okamura, portfolio manager at Neuberger Berman, who's still bullish on Japanese equities and thinks Japan will continue to remain a favored destination for foreign businesses and investor capital in 2025. Kei, always great to have you in studio.
Thank you for having me.
Right now, the headlines, and we're trading around potential tariffs. Are tariffs coming? Are tariffs not coming? We're not seeing anything direct against Japan as of yet. But how should investors be watching the Japanese market given the uncertainties globally?
Right. Split this up into near term and mid to long term. Near term, I think Japan, like all other countries, is not exempt from some of these risks, clearly. That being said, on the mid to long term, when you look at Japan's geographical location next to Asia and its historically long alliance with Western nations like the U.S., Europe, that's foundational for international trade and investments. And that's exactly why global businesses have been investing in Japan, especially in the semiconductor value chain over years and billions of dollars. And so we think that over the mid to long term, Japan will remain a strategic partner to the U.S., and that should bode well for Japan's growth going forward.
Short term, though, given, of course, perhaps we could see the yen again performing the safe haven currency role a little bit. I mean, it hasn't done that in the past year or so. But if we do have more yen strength, especially with the BOJ tightening, what are the implications for equities?
Yep. This is something that we're also looking at as well, given that we run concentrated strategies looking at Japan. Our base view is that as the Bank of Japan continues to normalize monetary policy, as we had seen last week, and then concurrently as we see the U.S. Federal Reserve looking to cut interest rates down the line, we think that the narrowing interest rate differentials will lead to the yen to appreciate. What that would also mean is that for domestic-oriented Japanese companies, those that gain most of their revenues from Japan with consumers that are the end demand, for example, in Japan, they would tend to benefit because they'll see lower imported cost inflation, and at the same time, spending would be improved thanks to higher wages, which is obviously a key issue that the Bank of Japan was looking at last week. So that's sort of the area that we're looking at in the Japan equity space.
We heard earlier from Sayuri Shirai, who used to be a former BOJ board member, and she was talking about the fact that the BOJ should just be transparent when it comes to the reasoning behind tightening, which is more to do with the yen than with anything else. Take a listen.
BOJs, I think it's not very honest about why they are raising interest rates. So that's why people are really confused. A lot of people who are there, press people at the press conference probably didn't really get it, what they're doing. So in the meanwhile, the governor says this is cost push, yen's depreciation, rice price, etc. And they say underlying inflation is picking up. But to me, I look at various data, but I don't really see a sign that underlying inflation is picking up.
The underlying inflation that Shirai-san is talking about is also, of course, to do with the wage growth that you mentioned earlier. But at the same time, if you're targeting these domestic-focused companies, would a higher rate environment make it tougher on them as well?
We've been discussing with many of our holdings in, say, the consumer staples and consumer discretionary, those exposed to the end demand. At the moment, their concern on rising interest rates is not that high. If anything, right now, their biggest concern is about the labor shortage and also their abilities to continue to pass on rising input costs, which will be critical to protect margins. We think that down the line, though, as Shirai-san mentioned, this issue about whether the Bank of Japan can tackle the weak yen is going to be absolutely vital for the Japan inflation story. Our view is that the Bank of Japan will be able to do so. But I think the important part is that they can't necessarily be too linked to the currency markets. If they become too directly communicating to currency markets, that alone could create volatility, which is akin to what we saw last July and August. So it's a difficult task. I mean, it's like addressing the elephant in the room without actually addressing it. But honestly speaking, I think the Bank of Japan can do so going forward.
Especially given right now, it seems to be the broad consensus that we might see the pace of tightening be around every 6 months or so. Can the stock markets take this?
We think so. I mean, Governor Ueda came into the top spot in April of 2023. Since then, we've seen interest rate hikes 3 times, 4 to 6 month intervals, which is, absolutely gradual, nowhere near the same pace that we saw in U.S. and Europe. I think from our standpoint, that is something that most companies can tackle. And, if you look also that many of these Japanese export companies have said, they expect the yen around 145 or so. This is very, very conservative. So as we go into third quarter earnings next week, and then, of course, full year earnings in April and May, we'll begin to see a better visibility into the earnings outlook for next year. I think most market participants will be surprised at the level of earnings growth we can expect if the yen continues to remain at these current levels.
Kei Okamura, good to have you back in the Tokyo studio. He's portfolio manager at Neuberger Berman. As we continue to check the markets for reaction to the White House now saying that the U.S. has been able to get Colombia to agree on all of those terms when it comes to migration and migrants being deported from the U.S. We're now seeing oil under a little bit of pressure. We have seen those moves given that Colombia is the 4th largest exporter of oil into the U.S. market. We continue to watch the commodity space with a Brent crude above $78 a barrel. This is Bloomberg. Welcome back. You're watching Insight. U.S. futures in the red as progress made by a Chinese AI firm seems to be threatening American dominance of the tech industry at a fraction of the cost. That's because AI models from DeepSeek have been scoring impressively on global benchmarks. The free open source large language model was unveiled in December. The lab behind it says it took 2 months and under $6 million to build. That's a fraction of what OpenAI and Google spent to train their models. For more on this potential AI disruptor, Bloomberg Intelligence senior analyst Robert Lee joins us now. Robert, so what exactly is DeepSeek doing and why is it making such big waves in today's trading session?
Okay, I would say to sort of Asian and Chinese investors, actually DeepSeek's been known for at least 6-7 months or so. There's a good reason why it hasn't made headlines in the US to date, and I'll come on to that in a second. But as I think people are well aware, these US export controls on the semiconductor side have caused put a major bottleneck in the road for Chinese AI companies. So like any challenge in life, you need to find a way around that. And so Chinese companies have increasingly turned to innovation. So DeepSeek being a prime example of that. So DeepSeek's model, in comparison to both domestic models here in China and with their overseas competitors, is a lot more computationally less intensive. And that means it's more adept at running on locally sourced chips, and also will realize some significant cost advantages. And I think that's what the market, particularly on the US side, has woken up to.
It raises really doubts about how far behind China's AI technology is against the U.S. at this point, right? When it comes to the secret sauce for what makes DeepSeek DeepSeek, what do we know at this stage?
Okay, so DeepSeek has employed what's known as a mixture of experts architecture, and sort of skimming over the technical detail. Again, it's more computationally efficient and therefore more cost-effective than the somewhat brute force approach that is employed by a lot of other AI companies at the moment. So this has allowed them to deliver significant cost savings. There are news reports of the inference costs, for example, costing as low as $6 million, which I must say doesn't sound particularly credible, but I think the evidence is there that their model is highly competitive and probably is substantially cheaper to both develop and run than most of their competition, both in this part of the world and in the US. And that's why this company is making headlines.
Already we had these doubts about how much capex all of these tech giants were using, especially these frothy valuations. So what does this mean for big U.S. tech companies, not to mention Chinese tech firms like Tencent and Alibaba?
Well, again, as I just mentioned, this brute force approach, I think, can't be the way forward. And this is the sort of engineering me speaking. There's been all sorts of speculation, even in the US, about restarting nuclear reactors, given the very high energy costs of these models. It just doesn't really make sense. So I think the direction of travel for the industry as a whole, perhaps to some degree innovated and led by some Chinese firms, is to try and be more cost-effective and computationally effective. Smaller models that are cheaper and easier to run has to be the way forward. And the technical barriers to entry on software are substantially lower in comparison to something like semiconductors. China also has some inherent key strengths in software development, with Alibaba and Tencent as key examples of two leading global firms that the Chinese have in the sector. So, China's really good at software innovation, and I think the emergence of a firm like DeepSeek confirms the competitiveness of Chinese companies and the fact that things remain broadly open, and the field remains wide open at this point. So I think China is well positioned, really closely behind the US as the number 2 globally in AI, and I think there is still scope for them to further narrow the gap. So these export controls from the US have actually spurred China on to innovate. And as I said, the fact that DeepSeek is making the headlines, that's a prime example of the progress they're making at the moment.
Bloomberg Intelligence senior analyst Robert Lee, as we continue to watch those tech stocks trading across Asia at the moment. And we also do have an alert on the Bloomberg. We just heard from the Colombian Foreign Affairs Minister Luis Murillo speaking in a webcast saying that Colombia will continue to accept migrants from the U.S. and that the two countries have overcome an impasse. Given, of course, that we had seen President Trump imposing those tariffs and travel bans on Colombia after it refused to accept deported migrants on military planes. We had already heard from Gustavo Petro, the president of Colombia, responding by imposing retaliatory tariffs. But at the moment, we have heard from the White House that Colombia has accepted all of President Trump's terms. And right now, Colombia also confirming those news, saying that they will continue accepting migrants from the U.S. Of course, we saw already the reaction in the markets with the U.S. dollar paring back some of those earlier gains. Avril Hong has been tracking the FX moves around all of these Trump tariff news. Avril.
Yeah, absolutely. Sherry, I mean, you think back to last week, not just about the reaction today. It was, I think, the dollar in focus as a really clear read of markets' expectations and perhaps a recalibration to what they think Trump's approach to tariffs were going to be. And now, you know, last week was a lot about talk and little action. Today, it's about action on Colombia. And given the sort of, you know, overcoming of some of these differences, we've seen the dollar actually pairing some of the earlier gains. That being said, it just demonstrates the risks of tariffs for markets. And we're seeing how today the Mexican peso, South African rand, they're leading declines in the EM space among the G10s. Almost all of them are losing ground against the greenback, save for the Japanese yen. And you think back to last week as well, where the dollar capped off its worst week in 14 months. And this was amid the expectations, or rather, you know, the sense, the perception that Trump was taking a softer stance on China. If we can just flip the board and take a look at some of these daily moves on the greenback, and you'll see as well that this week, I think, is much to do with the Federal Reserve. If we see that pause, it would, of course, be the first one since September when the rate cutting cycle began. Keep in mind as well that despite the tariff risk, there are some who see bias lower for the U.S. yields, the dollar as well, especially if Powell talks about data dependency and then leaves these rate cut expectations intact, Sherry.
Avril, stay around because we want to bring in our next guest who expects the dollar to rebound and stay strong in the coming months. Teck Leng is APAC FX and macro strategist at UBS Wealth Management. Teck, good to have you with us. Of course, Avril was talking a little bit about the fluctuations that we've already seen on the greenback. But given that we are headed essentially to the FOMC holding rates steady, to the ECB cutting rates, is it inevitable at least for now, that we're going to continue to see strength?
Yeah, I think, Sherry, what we have been looking at in the past week, the worst week for the dollar in recent months, is really just positioning adjustment. Because I think if you think about how much the dollar has already strengthened since Trump won the elections in early November, the dollar index basically strengthened more than 5%. This is despite not having formal trade tariffs being erected, right? So I think there is a lot of front loading of dollar strength, and therefore, when Trump actually appeared to be taking a softer stance to tariff imposition, it is actually pretty natural for the dollar to give up some ground. But I think just on a fundamental basis, we are still heading into a period where US data is still strong. The Fed is actually just going to stay hawkish as compared to the rest of the European central banks. So I think that it should actually be quite predictable. This FOMC should actually be reiterating that there is no hurry in cutting rates. There is 2 rate cuts that we expect as a bank as well, but that is going to be on the second half. Whereas the ECB is almost on autopilot. For every meeting in the first half of this year, they are actually expected to cut rates. So I think over the next 6 months, ECB cuts by 100 basis points.
When it comes to President Trump himself and all of these tariff news, not to mention, of course, the comments around the Federal Reserve, he's not necessarily a stickler for fundamentals, right? He does not necessarily like other currencies to be weaker than the U.S. dollar because he thinks that then they get a competitive edge when it comes to trade. You've pinpointed to the Plaza Accord, and the Plaza Accord version of 2.0 being the biggest risk for currency markets. Explain to us why.
Yeah, I would say that would be totally unexpected because firstly, the historical context of Plaza Accord hasn't really gone down well, particularly with Japan, because it actually led them inevitably into 2 decades of deflation. So I think there is a bit of a historical learning, whether, for example, Japan wants to do it the same way as it did in 1985, whether China wants to follow in that footstep as well. So there is a little bit of a concern with regards to whether they want to worsen deflation, because if the currency strengthens, that is actually deflationary for an economy like China, for example. So I think what the playbook really in the next 6 to 12 months is that there would rather be escalation before de-escalation. And I think we are still bracing for more pain. And when we do get the escalation, the dollar strength can actually persist at least over the next 3 to 6 months.
the pricing in that we've been seeing in FX markets on the greenback strength up until last week, where it took a bit of a breather, do you think that's more tariff risk? Does that also account for retaliatory action from those that might see target from Trump?
Yeah, so actually, so far, it has been playing out very quickly. For example, Mexico, and this time around Colombia, the escalation was very quickly met by very strong words from the opposing leader of the government. But I think just for optics, it is necessary to do that. But of course, behind the scenes, when their ministers work out at the working level, it was very quickly diffused as well. So I think the market is almost adjusting to a new tempo of tariff negotiation. In the first place, it wasn't about tariff, it was about immigration and drugs, right? So until we actually see the USTR coming out with the official report and the tariff escalation actually being announced properly over the next 6 to 12 months, what we are getting near term is actually mostly talk. And that is actually not materially shifting the dollar as it has already.
Do you think Powell this week will give markets enough to look past the tariff risk?
Yeah, I don't think so, because actually Powell did flag what is coming up in terms of tariff as a potential needle mover for inflation, and also the impact on growth as well, right? So I think he will be giving very little away. He is still actually trying to anticipate what is the economic and macro impact from the tariff. And in the meantime, he's really operating with the rear-view mirror approach that unless there is evidence of slowdown in inflation and labor market easing, he would actually just stay hawkish as we expect.
So what are you seeing in the data right now? Because we saw yields really getting pressured after we got inflation cooling down in the U.S. recently for January.
Yeah, as far as the data is concerned, I think if you look at the inflation in the US, still stuck around the 3% mark. Whereas in other parts of the world, China is still struggling with deflation. I think what we are looking at in terms of interest rate futures pricing is actually the correct one. So the market is actually pricing in slightly less than 2 cuts out of the Fed. It is closer to 4 cuts in the ECB. So I think what we really need to see is that inflation data in the US in particular is only likely to ease maybe in the back half of this year. That is barring a shock from the tariff threat. But if you look at the lag impact between the private rents and what is showing up in the owner's equivalent rent translation, actually I think in 6 months' time, we could actually be getting signs of inflation decelerating in the US, which actually lays the ground for the Fed to cut rates in the second half by 2 times.
Teck, when it comes to China, you mentioned, of course, the pressure that economy is facing. We saw the data today, industrial profits declining for a 3rd consecutive year, not to mention manufacturing PMI also falling into contraction. Is that why you're also long dollar China renminbi?
Yeah, so I think we are long the US dollar against the Chinese yuan for a variety of reasons. The first is, of course, trade escalation has yet to start. And if 2018-19 is any precedence, the pressure on the Chinese yuan will only continue to rise, right? So what we are getting is really a stabilization of the fixing anchor. But when the pressure from the tariff takes effect, I think 7.5 is almost inevitable if it goes into the direction. The second is being economic fundamental divergence. And if you actually look at the interest rate differential with China 10-year yields having fallen to new lows, actually the dollar CNY should not be trading at 7.2. It should be trading closer to 7.4 and 5. So with that in mind, until they show promising signs that of a stabilization in the property market, unfortunately, the economic dynamics doesn't favor a turnaround in the Chinese yuan at the moment.
You're long Aussie dollar as well. Why? I mean, it's seen as this proxy to the China tariff risk.
Yeah. So, in fact, I think that is the common argument against being long the Australian dollar, because it is very sensitive to Chinese yuan weakness. But I think the opportunity here that we see is a very big dislocation where the interest rates are suggesting for the Aussie dollar it is actually implying that the Aussie is undervalued by about 10%, where interest rate is concerned, it should be trading closer to the 69 cents. And the second big difference is that if you look at 2018, where the Aussie did fall by almost 10%, interest rates back then was suggesting that it was overvalued. So we are getting a complete opposite dynamic in terms of currency valuation. And I think this times the market is already overshot in terms of the pessimistic sentiment.
And Teck, really playing rate differentials, one of the best carry trade strategies for years has been really using the cheap Japanese yen to play against, say, the higher yielding South American currencies like the Brazilian real or the Mexican peso. But given right now the tariff implications against these South American countries, not to mention the tightening of the BOJ, how will this trade work out?
Yeah. In fact, I think the yen carry trade will no longer come back in the same scale and enthusiasm as the past 3 years. Because I think we are at the point where if you look for a favorite funding currency, actually the yen doesn't stand out right now. Policy rate has been increased to 0.25 to 0.5%. That is actually on par with the Swiss National Bank, right? And if you imagine Swiss National Bank making one more cut in March, in fact, that is where the target is, the lowest currency of interest cost. And I think the market is still very fresh from the scarring effect that there was a 20 yen move last year in between July to September. Right. So if you are looking for a funding currency, do you necessarily want to use the yen with that kind of 20%, 20 yen move that you might actually get hurt, right? So I do think that yen carry trade is behind us, but having said that, the pace of yen rebound would also take time because the pace of BOJ normalization would actually be gradual. So I think what we are looking for really is, for example, the dollar yen should actually be an orderly process adjusting towards 149 to 145 in 12 to 18 months.
What about using the Indian rupee? I mean, it seems that record lows against the U.S. dollar might be inevitable given the trajectory of the Fed versus the RBI as well.
Yeah, so the market is indeed getting very bearish on the Indian rupee. But I think Indian rupee, the difficulty of the market shorting it on a larger scale is that it is a very high yielding currency, even though they are not willing to be holding on risk going long the rupee for the yield, but they are also finding it very difficult to short. And I think the argument about Indian rupee being overvalued in real exchange rate terms is actually not a very solid one, because I think when it comes to valuations, what really translates to is that whether it is causing big imbalances in the current account dynamic. And if you look at the Indian rupee, in Indian economy, current account deficit is about 1 to 1.5%. It is not the most terrible level that it has seen over the past 20 years. So I think expecting a big depreciation in the rupee is equally hard as well. We wouldn't be standing in front of the negative sentiment, but at the same time, I think we should be circumspect about whether the currency is going to undergo a more rapid devaluation from here.
Teck Leng Tan, good to have you with us of UBS Wealth Management on everything to do with FX, and of course our very own Avril Hong. Coming up, we actually focus more on India because we're now seeing the stock markets losing their mojo. Thanks a lot to do with the cooling economy and the exodus of foreign investments. And today we're seeing that big drag coming from the tech sector as well. A closer look. This is Bloomberg. Broad downside across markets in India right now. We are seeing the tech sector, one of the big decliners on the Nifty, down about 1% for the overall sector. And of course, a lot to do with that concern about China's DeepSeek AI capabilities and that really taking away from the dominance of U.S. tech firms and their suppliers across Asia. And broadly speaking, we have seen this prolonged rut when it comes to Indian stocks. The benchmark Nifty on track for a fourth straight month of losses. That would be the longest monthly losing streak in more than 2 decades. For more, let's bring in Bloomberg's equity senior reporter Abhishek Vishnoi in Singapore. Abhishek, why are we seeing this broader downside when it comes to Indian equities?
Well, it's largely a call on whether Indian market is expensive, whether the growth outlook is fading a bit. So, what our reporting is suggesting is that the blue sky scenario for India, the top-notch bull case scenario, that is sort of weakening a bit because economic growth has slowed down. I think there is a big enough size and scope on that. And with that, the country's leadership, this time around, Prime Minister Narendra Modi is leading a coalition. So there have been these, small tweaks to India investment thesis. But look, this is only a tweak to the blue sky scenario. The long-term thesis still stays intact. Now, given the valuations where, India's of Indian assets are, we have seen some pruning of optimism. You yourself said that this is a monthly decline, probably the biggest in a few months. Nifty is down about 12% from a peak in September. A lot of foreign money has gone out. Since the end of September, I think about $19 billion have moved out. That's a huge chunk of money. Now, that really matters at this point because while retail investors are investing, somehow this foreign outflow has overpowered the local money that has been coming in, has started overpowering. So that's a big chunk of money that has gone out. Rupee is trading near record lows, has just made successive record lows. So there is a little bit of tweak to that India investment thesis, and that optimism, that allure is fading a bit.
And we have seen today's session, for example, Teck leading the sell-off. It seems to be a broader theme around, especially that concern about China's DeepSeek.
Oh, absolutely. DeepSeek has permeated into all sort of risk assets this morning. It started with the tariff news, from Colombia and Trump. But DeepSeek is why Nasdaq futures are down about closer to 2%. And that is just going into all kind of AI stocks. Indian IT companies come way lower in that pedigree because they are yet to join that AI-led boom that the world has seen. But nevertheless, Nasdaq's lead is getting reflected in Indian IT stocks as well. But DeepSeek does put a bid on China stocks, but it's not like a panacea to China's problems. What our reporting is showing is that this definitely may lead, if true, may lead China to skip some steps and be right there in terms of tech supremacy. But it's not a panacea to their problem.
We'll have to leave it there. We're out of time. Abhishek Vishnoi, Bloomberg Equity Senior Reporter, with a look at the broader markets. And of course, for tomorrow at Insight, State Bank of Pakistan Governor Jamil Ahmad joins us for an exclusive interview following the rate decision today. Economy is expecting a cut of at least 100 basis points. Horizons Middle East and Africa is next. This is Bloomberg.